if I look at markets real quickly around the world to try to get a bearing on is there value out there, if we look at developed markets, they're somewhere around their average, so that's not overpriced. If we go all the way down to emerging markets, we can see that they are very undervalued as compared to their historical average. What's your takeaway there is, if you'll notice, they've been undervalued for quite some time. So even though something's a bargain doesn't mean that it's going to appreciate in value anytime soon. Now here's a chart I've never seen before, and this is a 5,000-year phenomena. Never in the history of fixed income or bond issuance do you see yield curves like this. And to orient you, the line across the middle is zero. That's your zero interest rate. Down below that are all the sovereign offerings that trade at a negative yield to maturity. You automatically lose money if you buy these securities. And one time during July, of total outstanding debt, sovereign debt, over $50 trillion, 13 of it was negative. $13 trillion trading at a negative yield to maturity. So where am I going with this? Here's the problem facing retirees today. If you go back on this chart, back to 1995, I could take a retiree's portfolio, create an expected rate of return of about 7.5% and a standard deviation of 6. Why does that matter? Well, it matters greatly if you think about the portfolio's volatility within that experience would be somewhere around a positive 13 for a year or a positive 1 in a given year. So if you're taking out 3 to 5% of your nest egg every year, that standard deviation works for you over time. Fast forward, we now have negative interest rates. What risk do I have to assume to get that same expected return today? It's a 17% standard deviation. And I'm submitting to you here today that for the average retiree, this is an unacceptable standard deviation. You are not going to make it. And the reason why I say that with such confidence is everybody in this room looking around is familiar with what they call a black swan event.
And then if you look at this next slide, this is the question that most entrepreneurs want to keep track of is, what are valuations like? How are valuations changing? And I think if we look at what's going on year to date this year, and we look at this historically, what we're showing, first of all, that dotted line in the middle is sort of the average of all middle market, lower middle market transactions, and that's companies that are from $10 to $250 million in value. So you can see that, that has trended up. It was much higher, though, in 2015. It's down somewhat this year. And then you see the same thing for the larger transactions and the smaller. And the other thing that you see in here is there consistently is a size premium that's evident in the middle market. And that's consistent with the same kind of size premium that you see in the public capital markets. So, I think that one of the things that we always impress upon people is, part of your decision as to when to do something has a lot to do with, sort of your outside the firm goals and objectives, but also, there's a real break between a 5 million EBITDA company and a 10 million EBITDA company. The other half of that slide is what's going on with leverage, because the private equity machine works off of leverage. And we've consistently seen that multiples that they are able to pay are very sensitive to the amount of debt leverage they can put on a company. So what we see that's happened over, since 2010, we see the multiples in these transactions going from 3 times total debt to almost 4 times total debt. And if you look at that, it's been pretty consistent. 1 EBITDA turn has been coming from sub-debt, so all of that expansion in leverage has been basically the result of commercial banks who were very, very tight in the underwriting in 2009 and 10, but they've slowly become more liberal in the way they underwrite transactions.
Second theme is, it may not feel like it, but this recovery is a bit long in the tooth. One of the things that's driving such poor rate environment, obviously, is the stagnant growth in the world economy. And in the U.S. in particular, since the Great Recession, which officially ended in Q2 of 2009, as you can see on the far right, we've had subpar economic growth over that time frame. You know, subpar by any measure looking at history. You know, other recessions were followed by, you know, robust growth. We've been kind of limping along, as everybody is aware, and that has driven the economic cycle as well as the interest rates. And, you know, we have across the world, as Drew alluded to on that one slide, you know, governments across the globe, you know, trying to stimulate their economies and have negative interest rates. There's still lingering concern over China and Europe in terms of what their growth potential is. And so, you know, there's not a lot of great news out there to suggest that we're going to see some rebound in growth and, you know, globally. But in the U.S., you know, we're the nicest house in a crummy neighborhood. So, you know, there's some sentiment that things are doing well here, and we're, you know, rate hike is imminent. So what kind of advice would I give you as if you're a debt market participant and you're trying to think about, well, what does all this mean, and what should I do to best able to access the senior debt markets? You know, my favorite, this is something I've learned over the years, it's raise debt or raise capital opportunistically, you know, when you can, not when you need to. So, you know, the best advice I'd give is watch the trends, but always make sure that you're extending your maturities, you know, reprice your deal when it's attractive to do it, amend your covenants in a favorable way when you can. Don't just wait for an event to trigger it. I also suggest you watch the capital flows because, as I said, middle market, it's hard to get data a lot of times on what middle market trends are doing. But the overall capital markets, the funds flow of money going into high yield markets or other debt markets, and what's going on with the equity markets and the funds flow between debt and equity investments, those things are indicative or, you know, provide some guidance as to where things are headed in the senior debt markets. You know, keep your relevant financial information updated and fresh. You know, always have a deck to share with somebody and explain what your business is doing and how things are going and what your strategies are. Excuse me, because it's always good to be ready to talk to somebody who may be able to provide you some capital. And then lastly, you know, take those bankers up on their offer to take you to lunch. You know, don't say, oh, well, I don't really, you know, want to go out. I got better things to do. My advice is, you know, don't keep all your eggs in one basket, and, you know, keep the flow of information and maintain those relationships because you just want to keep all your options open, you know, depending on what's going on in the cycle. So that's it for me. Thanks.